Hello guys, how are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Jerry Mtimkulu. In this video, we are going to discuss VAT in the United Kingdom, the value added tax. So our job is going to be easier because the syllabus area is not that long and we just need to have an understanding of the basics. All right, so to those who are new to this channel, please subscribe so that you get more content of similar nature. I teach the ACCA qualification from the grassroots to the strategic level. Okay, as you can see, I'm an FCCA, which means I'm somebody who has been trained, who has gone through the same route you are embarking. All right, but you need not to be an ACCA student to, to watch these videos. Even if you're a student at a university, you are going to be helped by this presentation. Okay, now this is an overview. All right, and this video is likely to be very, very useful if you are going to attempt the ACCA taxation UK variant paper or examination this coming September, December 2025 or March 2026. All right, you will be helped with this presentation. Now, what is VAT? What is value added tax? Ad valorem. What is that? Okay, this is a tax which is levied, okay, on the supply of goods and services, right? That's the VAT, okay? It is tax which is levied on the supply of goods and services, right? The standard rate for VAT is 20%, which means this is just the same rate which was applied in the financial year of 2023. So for the financial year 2024, we are going to use the same rate of 20% as the standard rate. Then there are also other rates which apply. The 5% rate with the pen, all right, 5% rate and the 0%. Those rates are applicable, ladies and gentlemen. You need not to ignore them. So when you'll be reading the scenario, make sure that you know when to apply them. As I've indicated, VAT is levied on the supply of goods and services. All right. Supplies may be taxable, okay? Taxable supplies or exempt supplies. If you are looking at taxable, they are going to be standard rated supplies, reduced rate supplies, and zero rated supplies. All these are taxable. Okay, so the purpose of the presentation is to demystify why we are saying a zero rated supply is a taxable supply. You need to understand, by the end of the day, you need to understand that. Then exempt supply, all right? A supply which is zero rated is not an exempt supply. Even if the applicable percentages will be zero, okay? The zero applies in both cases, but their connotations or their implications are so wide and far different, okay? They are far much different. Exempt supplies, here there is no VAT being charged and there is no input tax recovery. Okay, so that's one of the hints you need to have, that when you are talking of exempt supplies, then it means that there won't be any VAT to be charged and the supplier is not going to recover any input tax they would have incurred in the production of those goods and services. All right, let's start with reduced rate supplies. Okay, reduced rate supplies. In UK VAT, okay, according to the Finance Act of 2024, the reduced rate of 5% applies to specific goods and services that the government wishes to make more affordable, usually for social, right, environmental, or public policy. All right, sometimes for the societal good, we just have to ensure that certain goods and services are charged a lower VAT, a lower VAT, to make them socially, enhancing. All right, some goods are a necessity and they need not to be too expensive. All right, so that is good for the societal well-being. Now, environmentally, we might as well want certain goods to be affordable so that the spillover effect will be good to the environment. So I'll give you the examples so that you understand what we are talking about. Then public policy. Sometimes, for governance purposes, certain goods have to be affordable to the general populace. All right, that might ensure, security-wise, the security of the country is guaranteed if certain goods are cheaper. So here are common examples. The first one is domestic fuel and power. Gas, electricity, heating oil, coal for domestic use. These ones are usually charged a lower VAT. Then, not for industrial or commercial purposes. If the fuel is not for industrial or commercial purposes, it is likely to be cheaper. Okay, it is just for domestic use, right? Then, energy-saving materials in certain residential properties, for example, installation materials, solar panels, heat pumps. All these are going to attract a reduced rate of VAT. Now, children's car seats and booster seats, these ones also attract a reduced VAT rate. Some residential property conversions, if you are converting your residential property or you are converting a certain property from non-residential to residential, you are likely to be charged a lower VAT. Altering number of dwellings, for example, one house into 2 flats, this one again is going to attract some input VAT advantage. Is that clear, ladies and gentlemen? Lastly, mobility aids for the elderly. If you are supplying and installing a domestic property for over 60s, something that is inclusive or accommodative of this special age group, you are likely to have some VAT advantage. All right? This also includes certain equipment that assists the elderly. You are likely to have some VAT advantage. Let us look at this particular scenario. Green Limited supplies gas to domestic household. For the quarter ended 30 June 2025, it issues sales invoices totaling £10,000 exclusive of VAT, which means there was no VAT involved. No VAT was charged. So you need to then compute their output VAT. Remember, they were suppliers. So output VAT is linked to the sales, and the sales invoice amount was £10,000, but there was no VAT included. So your job is to compute the VAT which was supposed to be charged. All right, and we are saying now that the VAT here, because the type of supplies attract reduced rate, you're not going to use the 20%, which is the standard rate, but you are going to use the 5% standard rate. Are we together, ladies and gentlemen? Good. And 5% of £10,000 gives us £500. So the total invoice to the customer, remember, VAT is going to be borne by the customer, the end user of the product. This is the guy who's going to suffer. So in this case, the government or the UK government does not want to burden the general populace when it comes to domestic fuels. So instead of these people paying a VAT of 20%, they are only going to pay 5% for those commodities. So 5% of £10,000 is £500. So the total invoice amount is going to be £10,000 plus £500, and this leads to 10,500. 10,500. Now, distinction between zero-rated and exempt supplies. Remember, so far we have looked at the reduced rate supplies. Now, we are having two elephants in the room which are almost identical but very, very, very different. Let's first look at the zero-rated supplies, which these ones attract a 0% VAT. VAT is charged at 0%, so taxable supply. There is taxable supply, all right, but the rate that will be applicable will be 0%. Seller can reclaim input VAT on related purchases. So sometimes what you are going to sell is not going to be allowed when it comes to the charging of VAT. You are not allowed to charge VAT on those items when it's selling to the end users, to the customers. But you might have incurred certain VAT charges when you were procuring your raw materials. So the taxman or the HMRC is saying, we are going to allow you to deduct. You're going to deduct that VAT which you were charged by your wholesalers or your suppliers of raw materials. An example of this setting is most food, all right? Most food, when being sold, are going to be zero-rated supplies, all right? But not fast food, offerings, all right? The chicken inns, or those other fast food offerings, all right? Or the KFCs. Those ones, they attract VAT in most jurisdictions. But if you're looking at other goods, like for example, millimil, all right, it is going to be zero rated. Okay, I'm giving these, examples to people mainly in African states, all right, like Zimbabwe and so forth, all right, who make use of millimil, all right. It's just a basic commodity, a basic food stuff, and it's good to be used as an example. Usually unprocessed, yes, unprocessed foods. Of course, they would have undergone some certain processing and so forth, but we are simply saying it's not yet that food that is ready to be eaten. Okay, it is a food, but you need to go home and prepare for the final food. Is that clear, ladies and gentlemen? If you are happy with the presentation, please just put a thumbs up emoji in the comment section to this video so that I'll feel motivated, so that I'll do more. Isn't it? Good. Right. Books and newspapers, printed books and newspapers. These ones, again, they attract a zero rate in the UK. Remember, this is a UK taxation. Don't just frown if this is against your tax jurisdiction. If you are attempting the UK tax examination, then you are home and dry. You need to hang on, need to stick around. Okay, children's clothing and footwear. This one again is a zero-rated supply. Passenger transport, international and long distance, UK. This one attracts zero rate. And exports of goods. These ones are also zero rated. Now let us go to the exempt supplies. Okay, ladies and gentlemen, now exempt supplies. No VAT charged, not a taxable supply. So this one is totally outside the VAT regime. Input VAT cannot be reclaimed on related purchases, right? Examples of these services include the finance and insurance services, postal services by Royal Mail, okay, education and training, health services by doctors and hospitals, betting, gaming, and lotteries. All these do not attract VAT. You are not allowed to reclaim any VAT. Okay, good. Now, why are these? Why are we saying they are different? What actually, I mean, explains their difference or give some reasons or some reasoning on their differences? Zero rated supplies. These are taxable supplies, all right? So in a way, we are trying to enlighten you further. Even though the VAT rate is 0%, the business is still within the VAT system. All right, so if you are saying that you are supplying a zero rated supply, you are still within the VAT regime. Although when you are selling out, when you are selling your products, you're not going to charge VAT, all right, or you charge a 0%. The effect is that you must issue VAT invoices showing the 0% VAT rate. Okay? And you are allowed to claim input tax on purchases because HMRC recognizes the sale as taxable. All right? On the other hand, if you're offering exempt supplies, you are offering supplies which are not VAT taxable. The business is outside the VAT regime. The effect is that you cannot charge VAT to customers. If they found that you were charging customers, you'll be in for a hot soup. You cannot reclaim VAT input on related purchases because no VAT will ever be collected on your sales. Is that clear? Let's look at this example. Zero rated supply, children's clothing. This is our first example, ladies and gentlemen. ABC Limited sells children's clothing, and we have already hinted that these ones are zero rated. But they indicate purchases at a cost of £10,000 plus 2,000 pounds VAT. Okay, so those were the cost of fabrics and materials. So in a way, ABC manufactures, or let me just say, does some clothing manufacturing. Okay, they buy fabrics and other materials. Okay, and then they tailor them into children's clothes. But in the UK, children's clothing are zero rated. So when they then made sales, they sold them for £20,000. Okay, they made sales of £20,000 and charged VAT at 0%. All right, so the output VAT, because it's a 0% multiplied by £20,000 comes to £0. So the output VAT is 0. However, they are allowed to claim input VAT on the purchases of £2,000. So this amount is fully recoverable. So their return to the HMRC would be for a refund of £2,000. Is that clear, ladies and gentlemen? Great. Now, example 2, this one we are talking of exempt supplies, private tuition. Okay, a college that is offering private tuition like the Transcal Business School, all right, in the UK. they will be offering exempt supplies. So let us look at this XYZ Limited. All right, they are providing private tuition, and we said this is exempt, VAT exempt, but they also incurred purchases which attracted input VAT of how much? £2,000. Then they paid a similar amount of 10,000 as the normal price of those sales, stationaries and materials. All right, then a VAT of 20% was charged on top. All right, and they made sales of the equivalent amount of £20,000. All right, so in terms of the output VAT, they are not allowed to charge any VAT, so we put a zero. Don't put a 0%, because these guys are outside the VAT regime, so no percentage apply. So if you put a 0%, you multiply the 20,000, multiply by 0%, even if it's going to attract a £0, by the end of the day, you're going to be penalized by the examiner. Why? Because if you put a percentage, you are simply saying that these guys, their offerings were within the VAT regime when it was outside, and you are going to be penalized. So you just put a £0, and in bracket, you just have to mention this one is exempt. It's not zero rated, it's exempt. Then input VAT. The VAT they suffered, these £2,000, is not recoverable. Okay, it becomes a cost, an operating expense. Am I talking to somebody? In your statement of profit or loss, that's an operating expense. It's not going to be found on the VAT cost. It's an operating expense. So the VAT return is going to be no reclaim. Business bears the VAT cost. All right. So, in other words, these guys are not, okay, they are not going to claim anything. All right. They're not going to claim anything. Okay. Somebody might be confused and say, but how come these guys, we said that if you're offering exempt supplies, you're outside the VAT regime, and now you're talking of the VAT return. What's going on? What's happening? Okay. If you are VAT registered, you need to submit a return. Okay. Even without any VAT payable and so forth, you need to submit a return. All right. Sometimes a business might be supplying both standard rated supplies as well as exempt supplies. Okay, it sometimes happens. All right. If you look at pharmaceutical businesses, sometimes they sell medicines and so forth, which might be zero rated, but at the same time, they might also supply, other offerings like perfumes, lotions, etc., which attract VAT. All right, and offering other businesses, maybe consultants, which could be exempt. So in that situation, all right, we are simply saying that if it is an exempt supply, then it also means that on your return, it should not lead you to an input tax recovery. Okay, as simple as that. All right, we will talk of VAT registration as we proceed with the presentation. All right, so allow me, ladies and gentlemen, to proceed on a systematic basis, right? On a step-by-step basis. Okay, ladies and gentlemen, so here is a takeaway on the differences. Zero rated are taxable supplies, and input VAT is recoverable. Exempt supplies are non-taxable, and input VAT is not allowed. Then, exam tip, always check if a supply is taxable, including 0%, to determine input VAT recovery. So this table, ladies and gentlemen, is very, 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 very essential. Okay, this is a table. Ladies and gentlemen. When we talk of output VAT in a zero rated, we are going to apply the 0%, and in exempt, we don't apply a percentage, okay, but it's simply a zero, right? Taxable supply, these ones, the zero rated, yes, they are taxable supplies, but exempt, they are not taxable. For VAT purposes, input VAT recovery, yes, you're allowed to deduct the input tax, but here you are not allowed. Then counts towards registration threshold, yes, those supplies are counted towards the registration threshold. You understand what we mean by registration thresholds as we proceed with the lecture, but here not counting towards registration. All right. All right. Example VAT return, okay, quarter ended 31st March 2025. So we are given this particular information about a certain business. Their standard rated sales were 128,000 pounds. Okay, they incurred costs of materials, 32,400 pounds. Expenses were 24,800, and machinery costs was 24,150 inclusive of VAT. You need to determine the VAT payable or refundable. Now, somebody might be confused and say, okay, fine, were those figures inclusive or exclusive of VAT? Now, if the examiner has given you all this information and then singled out a particular transaction saying that this figure was inclusive of VAT, so therefore all the other figures there you are seeing are going to be VAT exclusive. They were exclusive of VAT. Is that clear, ladies and gentlemen? Good. Now, determine the VAT payable or refundable. That's the question for us, ladies and gentlemen, and the computation has been done for you by the tutor. So we were told that they sold 128,000. They made sales of 120,000 pounds. Okay, so we were told the figures were not inclusive, they were exclusive of VAT. So we need to determine the VAT component, and we are going to use the standard rate of 20%, and this gives us the output VAT. Remember, on sales, we have got output. This is output VAT. And these ones, materials, these ones are purchases, expenses, and machineries. All these ones attract input. Okay, they are purchases. They follow the purchases style, isn't it? So your duty is to determine the net amount, which is going to be this figure. Right? Now, so this one, the figures here were exclusive, but this one was inclusive of VAT. So this is why we are multiplying with a 20 over 120 to determine the VAT component involved in this particular figure, because it was inside that figure. So for us to determine the VAT component, we then come up with that fraction. Is that clear? Now let's talk of VAT registration. Compulsory registration. The registration threshold for the financial year 2024 is 90,000 pounds. So if you are offering supplies and your revenue has reached 90,000 pounds, then it means you are going to be required, at law, you are required to register for VAT. So compulsory registration if historic test turnover is greater than 90,000 in the last 12 months, all right? Or the future test, the expected revenue is 90,000 in the next 30 days. So in the next, sometimes the examiner will give you a scenario and they are saying that in the next 30 days, they are likely to exceed 90,000. So you need to just have to pinpoint that these guys have to register. They are required at law to register. So effective date using the historic test, the first day of second month after exceeding. Okay, that's the date at which they were supposed to register. Remember, these attract some penalties if you do not register at that particular moment or time. Then the future test, this one, the date threshold expected to be exceeded. So that date when the 30 days will expire is the date you are supposed to register. Okay, that date when your revenue is expected to reach £90,000, then that's the date you need to register. What about voluntary registration? Okay, voluntary registration is for those entities whose turnover is below 90,000, but input VAT recovery is beneficial. Sometimes it is beneficial that you need to register voluntarily. Okay, just go to the HMRC and say, hey man, I think it's advantageous for my business, so let me just register for VAT. Okay, the advantage is that you will be allowed to claim input tax, input VAT. Okay, but if your turnover is declining, all right, it's declining to 88,000, you may deregister. Okay. Okay, but sometimes compulsory deregistration is when you cease to supply or you cease trade, then you are allowed to deregister. Okay, then voluntary, if turnover is reducing below 88,000, then you can as well, deregister. Okay, these points explain the deregistration further, right? You need, you must deregister if the business stops making taxable supplies or ceasing trade. We have already alluded that. No longer intends to make taxable supplies in the future. Okay, sometimes you supply things which are VAT exempt, so you will be required to deregister from VAT. If you do not deregister, it means that you need to satisfy those obligations like submitting of VAT returns and so forth. And if you do not deregister, it means that you will be charged. There will be penalties if you just ignore submitting those returns. So you need to deregister from the system. Is that clear? Now, voluntary deregistration can apply to you can apply to deregister if taxable turnover expected to fall below the deregistration threshold in the next 12 months. For financial year 2024, the threshold is 88%. So you then have to, if your turnover is expected to fall below the £88,000, then you can voluntarily deregister from the VAT system. So what is the process to be followed when deregistering? You need to make an application to the HMRC online or via the VAT form. If approved, deregistration usually takes effect from the date of application or a requested future date. After deregistration, the business stops charging VAT. You stop. Then you are also not allowed to reclaim input VAT on future purchases. You may need to account for output VAT on stock and assets held at deregistration if total VAT due would exceed £1,000. Is that clear? You need to account for that if the VAT payable is going to exceed £1,000. Now, example, VAT deregistration. A sole trader currently has taxable turnover of £70,000. Next year, they expect a turnover of £60,000, which is below 88,000. They may apply to HMRC for voluntary deregistration Exam tip, always quote the thresholds: £90,000 registration or £88,000 deregistration financial year 2024. Differentiate clearly between compulsory, okay, stop taxable trading, and voluntary, below the limit. So you need to clearly differentiate that. So if a business stops trading, then they are allowed it law. I mean, they are required, not allowed, but they are required to deregister. But if their sales are getting, below the threshold of £88,000, then they can voluntarily. It is not a requirement that if your sales are below 88,000, then you need to deregister. No, but you can volunteer to deregister. All right. You can volunteer to deregister. All right. Pre-registration input VAT recovery. All right. So the taxman might allow you to recover VAT on goods bought within 4 years, which are still in stock. All right. So sometimes when you go to register for VAT with the HMRC, there could have been some stocks within you which you would have bought. So the VAT, the HMRC will allow you to claim input tax on those ones, on those stocks which you incurred 4 years. Within 4 years of registration, you're allowed. Okay. So the UK is a good country when it comes to supporting businesses to grow, right? So you can claim VAT on those aspects. I think they are also encouraging good record keeping all the time. Now, services. You are required to recover VAT on services within 6 months of registration. So if you register today and then in the previous 2 or 3 months, you incurred certain purchases which attracted input tax, you are allowed to recover that input tax, even if you incurred the cost before registration. You are required. But there is an exception, okay? Exclusions. Consumed items and normally blocked VAT items are not going to be considered for recovery. Let us explain these things further. Consumed items, these are goods or services that were already used up or consumed before the VAT registration date. Since they no longer form part of the business taxable supply, the input VAT is not recovery. They were already consumed. So do not bother the HMRC with those items. Example, business registers for VAT on 1 July 2024. It bought stationery in April 2024 and already used it. VAT on that stationery is not recoverable because the goods are already consumed. But if the stationery was still in stock on 1 July, the VAT would be claimable. Normally blocked VAT items. Okay, even if goods or services are still held at registration, certain types of VAT are always disallowed under UK rules. These remain blocked regardless of registration timing. Examples of blocked VAT: business entertainment for non-employees, purchase of cars with any private use. So any input tax on these items is not going to be claimable. Certain non-business expenses are also not going to be allowed for VAT purposes. Summary on pre-registration VAT recovery. Claimable pre-registration VAT on stock last 4 years. We talked about these, and services last 6 months. Then the items not claimable, consumed, items which were consumed before registration. Then normally blocked items, cars for private use, client entertainment, etc. These ones are not going to be entertained by the HMRC. VAT for group companies, okay, or for groups. Okay, ladies and gentlemen, on VAT, there are certain conditions. I mean, on VAT for groups, there are certain conditions which have to be met. Companies established in the UK have to pay VAT, okay? But when we are talking of group companies or a group of companies, we are simply saying that these companies should be under a common control. When we are talking of a common control, we are talking of share capital, or I mean shareholding of 51% of equity capital. So there should be some 51% plus ownership of shares. All right, so they need to be under the same, I mean, a common control where the parent owns 51 plus percent of share capital. Now, the effect of, I mean, the VAT effect of or on groups is that companies should remit or should register, should have a single registration for VAT purposes. Right? So there should be one VAT registration for the group. Intra sales are going to be ignored. Okay, sales or supplies between companies are going to be ignored for VAT purposes, and one company is accountable for VAT liability. So, which means the HMRC, if there are maybe 3 companies, they are not going to pursue VAT on those 3 companies. One company would be a representative of the group for VAT purposes. All right, that's the idea. Now, how do we compute VAT liability? VAT payable is equal to output VAT minus input VAT. All right, VAT, even VAT refundable, that's the same formula. Okay, we are going to say output VAT less input VAT. Okay, VAT payable, I mean, results if the VAT is high, I mean, the output VAT is higher than the input VAT. However, if the input VAT is higher than the output, then we are going to have VAT refundable. Output VAT is charged on taxable sales, whereas input VAT is recoverable, I mean, is recovered on taxable and zero rated purchases. Blocked input VAT, we talked about this, where there is business entertainment, non-employees, cars with private use, all those things, we have already talked about those. Now, VAT accounting and tax points. Quarterly VAT returns under the Making Tax Digital Arrangement, okay, the MTD. The payment deadline for VAT purposes is 1 month plus 7 days post period end. Businesses have 1 month plus 7 days to submit the return and pay any VAT due to HMRC. This applies to both quarterly and monthly VAT returns. Okay, if you are having a quarterly or monthly VAT frequency, then it means that you are going to be given 1 month plus 7 days following the end of that period to submit the VAT return. Now, tax points, time of supply. When we talk of goods, we are simply talking of the goods supplied or when removed or when made available to a customer. Then it simply means that a supply of goods would have happened. If you are talking of services, if the service has been performed, then we are also going to say that a supply has been made. So when is VAT due? VAT is due on the earlier of invoice date and payment date, or sometimes or payment date. So the earlier of invoice date or payment date. VAT return. Example. One Limited's VAT quota ends on 31st March 2025. The deadline to submit their VAT return should be 1 month plus 7 days after the 31st of March. So if we calculate 1 month from the 31st of March, we are talking of 3rd April. Then we add 7 days. So they should submit the VAT return by the 7th of May 2025. If HMRC is owned VAT, payment must reach HMRC by the deadline electronic payment date. If VAT is refundable, HMRC will process after the return is submitted. Yes, they are the bosses, so you need to first submit a return. You satisfy them that the return is accurate, and then they start to process your payment, your refund. Important note: because VAT is a self-assessed tax, HMRC can make control visits to VAT registered companies. The purpose of control visits is to provide an opportunity for HMRC to check the accuracy of VAT returns. So be careful, do not just submit anything. Okay, the returns should be compliant with the Finance Act, with the VAT rules. Now, VAT invoice, the required information. A VAT registered business may have to issue VAT invoices in respect of standard rated supplies with the following information: supplier names and addresses, supplier VAT registration number, invoice and tax point date, description of goods or services, the net value, VAT rate, and VAT amount. Okay? When we talk of the VAT, the net value, we are talking of the amount without the VAT. Is that clear? Good. And then the VAT rate applied, as well as the VAT amount. Those should be shown on the invoice, among other things. Now, example VAT invoice: Oxford Traders registered for VAT on 1 March 2024. The company sells goods only and currently issues sales invoices that include the invoice date and invoice number, the type of supply, the quantity and description of the goods supplied, Oxford Traders Limited's name and address, the customer's name and address. The company does not offer any prompt payment discounts. Oxford Traders Limited seeks clarification on when it must issue VAT invoices, the time limit for doing so, and the extra details required for the invoices to be valid for VAT purposes. They seek clarification. Now, issue of VAT invoices. A VAT invoice must be issued when a standard rated supply is made to a VAT registered customer. All right? A VAT invoice is not required when the supply is exempt, zero rated, and supplied to a customer who is not VAT registration. So, if these three circumstances are met, then you are not required to to issue a VAT invoice. If the supply is exempt, you are not required. is zero rated, you are not, and is made or is supplied to a customer who is not VAT registered. Please get that right. Then a VAT invoice should be raised within 30 days of the date the supply is treated as made. That's the tax point. Now, additional information. For validity, under VAT rules, Oxford Traders Limited invoice must also show the company's VAT registration number, the date of the supply, the tax point, the rate of VAT applicable to each supply. Okay, is it 5%? Is it 20%? And so forth. Then, obviously, as we are saying that it is usually made for standard rated, okay, supplies. So therefore, the rate of 20% should be shown. Then VAT exclusive amount for each supply. So each supply you need to singularly detail or present the VAT exclusive amount for that supply. Then the total VAT exclusive amount on the invoice. Then the amount of VAT payable. Obviously, the total will be shown. Okay, that's the additional information. So tell me, have you seen the customer's name written anywhere? There was no customer name written anywhere. So in the examination, I don't want you guys to go crazy and say that the customer's name and address should be shown on the invoice. It's not a requirement. Are we together? Okay, simplified VAT invoices. A simplified or less detailed VAT invoice can be issued where the VAT inclusive total of the invoice is less than £250. An example: Kelly is registered for VAT, but only a few of her customers require a VAT invoice. Maybe their companies are interested in record keeping to the last cent, so they need that invoice for filing purposes. All of Kelly's sales are for less than £250. Now, a simplified invoice should be issued when a customer requests a VAT invoice. This must show the following information: Kelly's name and address. Remember, Kelly is the supplier. Okay, Kelly's VAT registration number, the date of the supply. Okay, that's the tax point. A description of the goods or services supplied, the VAT inclusive total, the rate of VAT. Now, I want you guys to tell me where you have seen the customer's name and address written. Again, even in the simplified VAT invoice, those details are not required. Maybe the taxman has seen the risk in including customers' private details. They might end up being robbed. Remember, for example, let's say a customer, who is very, very rich, after purchasing something in the supermarket, if his address are known, he might be tracked down by robbers. So the taxman has seen that risk. He doesn't require those details to be disclosed anyhow. So to avoid that risk, they do not require those details. Valuation of supplies. The VAT based on consideration received. VAT is actually based on on consideration received in cash or kind. Use market values if not at arm's length. Okay, maybe the transaction was between related parties, then in that case we need to use market values. Then we can as well use non-monetary exchange involved. We can use market value again if there was a non-monetary exchange involved. We have to look for the cost of those items which were exchanged in an open market or in the market to see how much would those things have cost. Then include delivery, packing, or incidental costs when you are. Remember, we want to value the items which were transferred. Those were the supplies, isn't it? Good. We need to exclude discounts and disbursements. Those have to be excluded. Let me take a call. Now, there are what are called VAT special schemes. These schemes are available to small businesses to reduce the work and amount of VAT payable. Okay, we have got three schemes or special schemes. The first one is the cash accounting. All right, sometimes the HMRC would allow businesses to adopt the cash accounting. Okay, usually it's about knowing the advantages and disadvantages of each of these. All right, so you need to tell to the examiner that if the business adopted the cash accounting for VAT purposes, then they are likely to benefit from this type or these forms of advantages and so forth. Okay, the second one is annual accounting. As before, you need to be able to determine how it operates and the advantages associated with it. Then lastly, the flat rate scheme. Now let's discuss each one of them at a time. Cash accounting scheme. How does this operate? The tax point is the date on which the output tax is received and the input tax is paid. Excuse me. So if a business is using the cash accounting scheme, then it means their date of supply, which is the tax point, is the date on which the output tax is received. Okay, so this is the date they are allowed to write on the invoice, the date at which they received something. For sales, it is the date that the cash is received from customers, and for purchases, it is the date that cash is paid to suppliers. What are the conditions for one to utilize the cash accounting scheme? The annual taxable turnover must not exceed £1,350,000. All right. Then VAT returns must be kept up to date. So for you to qualify, you need to ensure that your returns are up to date. Then a business must leave the scheme if annual taxable supplies exceeds 1.6 million. So when you reach some turnover of 1.6 million, then it means that you will then have to leave the scheme. The taxman won't be happy if you continue to be in the scheme when your annual taxable supplies have exceeded 1.6 billion pounds. What are the advantages of this scheme? A business will not pay output tax until received from customers. So until their customers pay, they are not required. They are not obliged to remit anything to HMRC. This is a cash flow advantage for the business. Yes, this gives some cash flow advantages. The scheme provides automatic bad debt relief, as output VAT will not have been paid on a sale until the cash is received from the customer. So if one of your customers ends up absconding, making payments or repaying their debt, then you're also covered. You're not obliged to pay any output VAT on those sales. Why? Because the customer did not pay you. All right. The scheme allows you not to pay because you were not paid by the customer. Here is an illustration. Rudo. Rudo. Or Rudo. Okay. In Shona, it's Rudo. So Rudo has an annual turnover of 1.2 million. All sales are standard rated and are made on credit for 60 days. All purchases are standard rated and are made on credit for 30 days. If Rudo opts into the cash accounting scheme, when will she need to account for VAT for her sales and purchases? All right. So solution is that Rudo will need to account for her standard rated sales 60 days after the sale is made, as this is when the cash is received. This will ensure that Rudo does not pay any output VAT for bad debts. She will need to account for her standard rated purchases 30 days after the purchases is made, as this is the date when the cash is going to be paid to the suppliers. Very clear, isn't it? Good. All right. Now the annual accounting scheme. How does this operate? One VAT return is prepared each year. The VAT return is due 2 months after the annual accounting VAT period, along with the balancing payment of VAT. 9 months of VAT are made from months 4 to 12 during the annual accounting period. These are 10% multiplied by the VAT paid last period. Right? The final payment, that is 2 months after the annual accounting period, is calculated as follows. VAT payable for the year minus 9 months or 9 payments made during months 4 to 12 during the period, which is equal to the balancing payment. The conditions to be met for one to utilize this scheme: the annual turnover, taxable turnover, must not exceed 1.3 million, 1.35 million. VAT returns must be kept up to date. A business must leave the scheme if annual taxable supplies exceeds 1.6 million. Advantages. Administration costs are saved. Only one VAT return is prepared per year. Regular monthly payments help the cash flow of the business. Small regular payments are made as opposed to less frequent large outflows. It simplifies accounting for VAT. Okay? Here's an illustration. Temba, for the year ended 31st December 2023, paid VAT of £10,000. He was eligible to enter the annual accounting scheme, and for the year ended 31st December 2024, he had VAT payable of £12,000. What were his payments during the year ended 31st December 2024? When did he make these payments? What was his balancing payment? When did he make this payment? Okay? Payments on account. Remember, we need to charge 10% multiplied by last year's VAT paid. The previous year they had paid £10,000 in the year 2023. So 10% of that's £1,000. So each month they need to pay £1,000. Payments on account were made from months 4 to 12. Okay, these are the 9 months during the year ended 31st December 2024. Therefore, they were made from April to December. This total 9 months on account. So the balancing payment would be VAT payable for the year. Remember, that's 12,000 according to the question, minus the total of the monthly payments. Remember, every month they were paying 1,000, which we computed there, multiplied by 9. So the amount outstanding, which has to be the last payment, should be 3,000. This payment is made 2 months after the year ended. Therefore, it is made on 28 February 2025. This type of stuff is commonly going to be tested as multiple choice. Be careful. Be careful. Okay. Good. The last scheme, the flat rate scheme. And these questions are also appearing in your assignment, this week's assignment. So please replay this part of the video for you to understand what was being said by the tutor. The flat rate scheme operates this way. VAT payable is computed using a flat rate of 16.5%. The flat rate percent differs from industry to industry. You will be told the percentage in the exam, so no need to cry. This percentage is multiplied by the sales revenue. The sales revenue used includes VAT, exempt supplies, and zero-rated supplies. Note, from the 6th of April 2017, there is a standard percentage of 16.5% for limited cost traders. This means that regardless of their industry, if they are deemed to be limited cost traders, then they must use the rate of 16.5%. You'll be told if this rate applies in the exam. Like I said, do not worry much. You'll be told by the examiner if you have to use the 16.5%. But now the question that might come is, what is a limited cost trader? Okay, roughly, this is a business that spends much less on its purchases than its, in relation to its turnover or its revenue. All right, maybe usually the cost of purchases is roughly around 2% of the turnover, something like that. All right, and almost roughly less than 2% of the VAT inclusive turnover or sales. That would be the cost of its purchases. So it is a limited cost business or a limited cost trader in a way. All right, their costs are so low. So what are the conditions for one to use the flat rate scheme? The annual taxable sales must not exceed £150,000. Okay, a business must leave the scheme once the turnover exceeds £230,000. Advantages: 1. Simplicity of the scheme. This is very, very simple. It's a very, very simple scheme. It reduces administration costs. Less detailed records of input and output VAT are needed. Right? Here's an illustration, ladies and gentlemen. Cutler Limited has annual sales of £84,000. These are standard rated and inclusive of VAT. The company also has standard rated expenses of £4,800, VAT inclusive. The flat rate is 16.5. Is it beneficial for the company to use the flat rate scheme or account for VAT normally? Okay, this is almost like a tax planning question. You need to justify the move from the normal VAT administration or VAT accounting to this particular scheme. So you need to advise the company if it is beneficial to them. All right. So the flat rate scheme, if we use the flat rate scheme, that's 16.5 multiplied by the turnover, and we can get the VAT payable of 13,860 pounds. However, if we continue using the normal accounting for VAT, we're gonna say output VAT. Okay, remember the figure here was the VAT inclusive. Okay, it was VAT inclusive. So the VAT component, the output tax here, that's 20 over 120 multiplied by 84,000 pounds, and we get 14,000 pounds. Okay, and the input, okay, we are told that they had incurred the 4,800 pounds of expenses. So we need to deduct those expenses from the output tax. So the expenses were VAT inclusive, so we need to regress with the fraction there. So we get that 800, and after deducting the 800 from the 14,000 pounds, we are left with the net of 13,200, okay, which is the VAT payable. So you can see that the normal accounting for VAT is leading us to a lower, this is lower payable than the scheme payable. This one is high, it's higher, right? 13,860 is higher than 30,200 pounds. So it is not beneficial for Cutler to opt into the flat rate scheme given these circumstances. Are there any reliefs available within the VAT regime? Bad debt relief, supply unpaid for over 6 months, for 6 months or over. Okay, so if the supplies are unpaid for over for 6 months or above, then you are allowed to write them down. Okay, becomes an allowable deduction or an expense, allowable expense. Sale of business as going concern. Okay, remember the TOGC, transfer of going concern. This one is not a VAT supply if the buyer is VAT registered. Okay, you're not going to remit any VAT. All right, with regards to that, all right, provided the buyer is a VAT registered operator. Okay, imports or exports. Exports is equal to zero rated. Okay, so if you are exporting your goods or services outside the country, outside the UK, then you need to zero rate them, but you are allowed to claim whatever input tax which was associated to the manufacture of those goods and services. All right, so by zero rating, it means that we are making the exports cheaper. This gives the UK a competitive edge. Okay, their products become cheaper on the global market, and they get more revenue, more foreign currency, right, through zero rating. But this arrangement is not going to negatively affect the supplier, okay, or the trader. Why? Because in as much as they are going to zero rate the goods, they are allowed to claim whatever input tax they would have incurred. Then on imports, VAT due is going to be postponed. Okay, usually when making imports, these UK traders were taxed. Okay, they were made to pay duty. Okay, or VAT on those imports at the borders, but now they are allowed to postpone. Okay, they are allowed to postpone and make whatever payments of VAT later on, not at the border, but after some time. All right, that is the idea. Uh, so that's a cash flow advantage, isn't it? Good. Now, VAT penalties, late submission. there is what is called a points-based penalty system. Points-based penalty system. All right, we'll talk much about that. Late payment is going to attract interest charged from the due date, and penalty escalates after 15 and 30 days. Don't worry, we'll talk much about that. Let's talk about the escalation rules on late payments. When VAT is not paid by the deadline, remember we said that at the end of the VAT period, you are allowed 1 month plus 7 days to submit your return and make whatever payments that have to be made. So, first 15 days after the deadline, no penalty if the VAT is paid in full within 15 days of the due date. Interest still applies from the original due date. Here, only the interest is going to be payable. Then, day 16 to day 30, if VAT is still unpaid, a 2% penalty is charged on the amount of outstanding at day 15. After 30 days, a further 2% penalty is charged on the amount still outstanding at day 30. So if VAT remains unpaid beyond 30 days, total payment is 4% of the outstanding VAT plus interest. Ongoing daily penalty. From day 31 onwards, an additional penalty of 4% per year is charged, accruing daily until the VAT is paid. Please refer to this part of the video until you understand what will be going on. Here is an example, ladies and gentlemen. VAT liability for the quarter, whatever it is, first quarter, second quarter, or it doesn't matter, was £12,000. The due date was 7 May 2024. Case 1 or scenario 1. If VAT is paid on 20 May 2024, that is 13 days late. Remember, the due date was 7 May, but we paid on 20 May, so that's 13 days late. This is within 15 days, so no penalty is going to be levied, but only interest. Then scenario 2, if the VAT is paid on 25 May 2024, that is 18 days late. This is beyond 15 days, but before 30 days. So 2% multiplied by 12,000 is going to be 240. So that's the immediate penalty plus the interest. Okay? It's going to be interest that is going to be charged on that. Now, case 3. The VAT is paid on 10 June 2024. That is 34 days late. Beyond 30 days, first penalty, we charged 2% of 12,000, which was 240. The second penalty, 2% of 12,000 pounds. All right. Now, this comes to 480. All right, plus the interest, plus daily penalty from 31 to 10 June. Okay, that's the idea. So in the exam, if a text question says VAT paid 18 days late, apply 2% penalty. If VAT paid 34 days late, apply 4% penalty plus daily penalty. Okay, that is from day 31 to day 34. That's when the daily penalty starts to apply. Now, more on interest on late VAT. Interest is separate from penalties. It applies from the day after the due date until the VAT is fully paid. The rate is going to be the Bank of England base rate, okay, or the London interbank rate, okay, plus the 2.5%, usually the LIBOR plus 2.5%, which is set by the HMRC. Interest is not tax deductible for corporation tax or income tax purposes. Do not deduct and say, hey man, we paid the VAT interest, so our expenses, so we should reduce our corporation tax because of that. No, it is not a tax allowable deduction. So we have the VAT liability of 10,000 as an example. Due date 7 May 2024. VAT actually paid on 6 June 2024, that is 30 days late. Assume the Bank of England base rate is equal to 5.25%. Interest rate is equal to 7.75%. Okay, that is the 5.25, which is the LIBOR rate, plus the 2.5%. We get this total rate. Interest is equal to 10,000 multiplied by 7.75% multiplied by 30 days over 365. Okay, and we get this amount of 4 pounds. Okay, this fraction was meant to reflect the number of days. Remember, we paid 30 days late, so we needed to to moderate, because otherwise if you only ends at 7.5%, this is the annual rate. It's the annual rate, but we only have to charge interest for 30 days. Be careful there. So HMRC charges interest 64 pounds. Then the penalty for late submission, which is 2% plus 2%, that is okay, because we paid after 30 days, so that's 4%, remember, and we get that one. So the total payable, that's 464 pounds extra, in addition to the 10,000 VAT due. All right. So key exam point: penalties are step-based, 15 and 30 days, then daily. Interest is continuous until payment is made. Thank you guys for watching. Okay, after watching the videos, you need to do the assignments. Okay, do the weekly assignment so that you cement, you understand, you discover that in the assignments there are tricky questions which you need to then use your reasoning capacity on top of the things you have been taught by the tutor, to ensure that you develop and become a good tax accountant. Until we meet next time, please continue to feel excited. Very, very excited. I'm signing out. Bye.